The stock market is doomed, and I'm selling everything. That's the kind of comment I'm seeing all over social media right now. I get it. Everything has dropped suddenly from stocks to cryptocurrencies, and I know that many of you who just started investing find this understandably very concerning. So today I thought I'd explain what's causing all this chaos and finally give you some guidance on how you can better navigate this storm. The most important thing is for you to hear the information so you can use it to your advantage. This is a video you shouldn't skip or watch halfway. So, why is the stock market plummeting? To put this in perspective, the S&P 500 fell 3%, the largest drop in a day in almost 2 years. The Dow fell 2%. Meanwhile, the Nasdaq dropped 3.4%. This seems quite alarming, and from what I've checked, there are 4 main reasons for this. So let's break them down one by one so we can see if we're facing another historic market decline similar to the financial crisis of 2008 or just a minor bump along the way. One of the reasons, of course, is the fear of recession. Now, if the economy were to enter a recession, the stock market would likely plummet. That's not always the case, as there have been some exceptions, like in the recession of 2020, when the S&P 500 returned 16.3% that year. However, that is not the norm. It makes sense because during a recession, less money is being spent by people like you and me. Companies start laying off staff, leading to more unemployed people, which causes people to spend even less. This results in companies also earning less, and most of the time stock prices are impacted. This is a vicious cycle, and I hope you can see why this would be a very bad situation. So, if we're not in a recession yet, why is the stock market falling? Because the stock market is known as an important indicator. Whenever there's a hint of a recession occurring, it reacts to that news quite negatively. So you're probably wondering what that hint was? Several data reports showed that the US added only 114,000 jobs in July, below expectations of around 150,000, and unemployment rose to 4%. This is higher than any month since October 2021. See, these numbers are far from a disaster. The unemployment rate is still relatively low, and the weak performance in hiring is not terrible. However, this has triggered something known as the SAR rule. This is a pretty cool little rule that gets activated when the average unemployment rate over 3 months increases by at least 0.5% compared to its lowest point last year. The reason people take this seriously is that it has accurately predicted all US recessions since World War II. In response, Goldman Sachs has raised its odds of a recession occurring next year from 15% to 25%. Interestingly, the woman who created the rule, Claudia S., doesn't believe the law will hold true this time. And to reassure you, there have been other rules like this before, such as the yield curves of bonds that have recently proven unreliable. One of the reasons this might be a false alarm is that this time unemployment is not rising because people are losing their dream jobs, but rather because more people are entering the workforce. However, as I mentioned earlier, rising unemployment is just one factor in the vicious cycle of a recession. Another important factor is the amount of money that ordinary people are spending. Unfortunately, it seems that spending is also decreasing. It may seem strange, but a good way to assess this is to check how companies like McDonald's and Walmart are doing. The companies recently stated that their customers are cutting back on spending, and another company to watch is Wayfair. They recently mentioned that customers are being very cautious, spending almost 25% less than they were 3 years ago. Now, all of this seems very concerning. However, when it comes to the S rule, even Goldman Sachs seems to agree that although they have increased their projections on the risk of recession, they still think it is quite unlikely. Also, for the bosses at the Federal Reserve to step in and protect the economy, which brings me to reason 2, it's interest rates. Right, check out this chart. The last times the Fed cut interest rates from a peak, a recession followed shortly after. And guess what happened? The US Federal Reserve hinted after its meeting at the end of July that interest rates would be cut soon. Now this chart also looks quite concerning, but it really doesn't show us the full picture to understand why this time is different from previous examples in the chart. We need to analyze why the Federal Reserve initially raised interest rates in 2020. The answer is simple. The pandemic hit the money printers at full throttle and supply chains were struggling, leading to high levels of inflation. The only way to bring prices back under control was to raise interest rates. This was an unprecedented situation that I think we won't see again. They set an inflation rate target to achieve, and said they would start cutting rates as soon as they reached it. This strategy worked, and inflation fell significantly from its peak of 99.1% in 2022, but it still remains slightly above the Fed's target rate of 2%. So now, if we go back to the chart, all those previous examples of the Fed cutting interest rates were attempts to prevent a recession. However, this time it's because they are very close to reaching their inflation rate target. So the Fed's interest rate cut should be seen as a positive move for investors because it helps boost the economy. When rates are lower, borrowing money becomes easier, which means more money flows. This is the opposite of what happens during a recession. So, on the surface, many of these factors seem concerning. However, when you dig a little deeper, it doesn't seem as bad as it looks. So what else caused the markets to fall so much that led me to reason about 3 tech stocks? If you recently invested in any of the major tech companies, then you would definitely have been hit harder than most, especially the stocks of a group known as the Magnificent Seven, which includes Apple, Amazon, Alphabet, Meta, Microsoft, Tesla, and Nvidia. Now you might be thinking that it's all fine. I don't invest in individual tech stocks. However, this also affects investors in the S&P 500 index fund, as these 7 major tech stocks actually represent about 31% of the S&P 500, which means that when tech stocks take a hard hit, the same happens to the entire index fund. So I think the obvious question is, why are tech stocks suffering? These stocks have been rising due to the promise of revolutionary AI technology. The AI craze has caused a bubble to form, pushing some stock prices higher than they should have been. Honestly, some people have already realized that the value of AI is not like the metaverse. This has been discussed a lot. I think the value of our current AI capabilities has been largely overhyped, and investors are recognizing this, causing stock prices to fall to more reasonable levels. I'm not alone in this thought, as Warren Buffett's firm here cut its stake in Apple by nearly 50% in the second quarter. There also seems to be bad news followed by more bad news coming from the AI space. Recently, Apple's initial AI preview fell short of the hype, and the highly anticipated Blackwell chips from Nvidia will be delayed due to design failures. These chip delays will also impact companies like Meta and Microsoft, so everything is quite interconnected. Overall, investors got a bit excited about AI, and it became somewhat of a buzzword. This reminds me of the dot-com bubble at the end of the 1990s. Just keep in mind that stocks with the biggest booms tend to fall. The biggest reason is the Japanese yen. Now imagine discovering this really clever loophole. You borrow money from someone with virtually no interest and invest it wisely. In the meantime, the value of the currency significantly drops by the time you need to pay back the loan. The money you owe is worth much less than when you borrowed it, but your investment has grown. So you end up paying back the devalued currency while profiting from the growth of your investment. Now that would be a pretty cool life hack, right? Well, it's exactly what many traders were doing with the Japanese yen. The yen has been declining in value for years. It's a neat trick to make easy money. Everything changed when the Bank of Japan decided to raise its main interest rate from nearly zero. Once again, countries tinkered with interest rates. This small change caused the value of the Japanese yen to increase, which means that everyone who took advantage of the loophole I just described was a bit screwed, as they had to sell their assets to cover their losses. Some experts believe this may be contributing to the current decline in the stock market, as all of this has happened. The Bank of Japan eased the pressure to raise interest rates again. This caused the yen to drop a bit, which helped calm concerns that a strong yen could once again disrupt the global stock market. So, as you can see, there are many reasons behind the recent decline in the stock market now that you have all the facts. Now you can adjust your investment strategy. As always, I am not a financial advisor, and none of this should be taken as financial advice. A very interesting phrase goes like this: start buying when there is blood in the water. In other words, when the stock market is declining and people are selling in a panic, driving prices to irrational levels, that is the time to step in and invest. There's another phrase that teaches the same thing: buy low. I know it should be obvious, but if you want to do this, then you need to make sure you have an emergency fund of at least 3 to 5 months of your living expenses. This is more crucial than ever since the stock market is in a turbulent moment, and you don't want to be forced to sell your stocks at a loss, only to find out later that if you had held onto them, you would have actually come out ahead. This essentially means buying at regular intervals as the price falls. This could be daily or weekly. If I were in your shoes, I would start my journey now. Yes, you can't guarantee returns, At least you are entering at a lower price. This basically means spreading your money across different baskets of assets such as stocks, bonds, and even cryptocurrencies. This is essential for reducing investment risk and smoothing the journey in a crazy market. Therefore, if one stock or sector is having a bad day, your other investments can help offset those losses. Technology companies are another good option. It may be worth investing in a US equity fund for even more diversification. Third, keep an eye on the long game. It's easy to be positive when your portfolio is growing, but when things start to go south and your gains begin to disappear, it can be really tempting to sell everything. Trying to guess the best times to buy and sell stocks is very difficult and often leads to wrong moves, according to Charles Schwab. Remember that if you sell when the market is down, you will be making those losses permanent. For example, during the market crisis caused by COVID in February 2020, if you had $1,000 in an ETF tracking the S&P 500, it would have lost more than 30% of its value. By selling it, you would have locked in those losses, but if you had held on, you would have seen your investment recover by August, just 7 months later. If you are waiting to get back into the market when things look better, you will likely end up paying more and losing out. So overall, remember that the US economy remains very strong, even after the losses. The S&P 500 index has still risen more than 9% since January. Market corrections, or a decline of at least 10% from the highs, occur on average every 1.5 to 2 years. So this is not crazy or unusual. In fact, I heard a really good quote the other day, and it went something like this. When the stock market goes up, it climbs the stairs, and when it goes down, it jumps out the window. This perfectly summarizes our current situation. Don't leave this video without subscribing to our channel if you want to grow your wealth. Until next time.